Section 4E in your book has a lot of useful information about income taxes. You should read it. But what I'm really hoping you'll get from this section is not how to calculate your tax as much as enough understanding that you can plan ahead for your taxes. There are two main things that you need to remember about income tax. One is that you don't pay tax on your entire income, and you can look at the taxable income slideshow for more information about how that works. The other is that different parts of your income are taxed at different rates. So the first part of your income that you earn at the beginning of the year will be taxed at one fairly low percentage rate. Then after that, the next part of your income is taxed at a somewhat higher rate. And once you've reached that cap, the next part of your income is taxed at an even higher rate, and so on until the end of the year. So depending on your income, you could be paying 2, 3, 4 different tax rates on it. So here's an example that shows a bit about how that works. Carrie had a taxable income of $31,450 last year, but she's been given an $1,800 raise. Assuming that the cutoff between the 15 and 25% tax brackets is at $32,400, and that Carrie has had no other changes in her tax situation, how much more federal income tax will she owe this year due to the raise? I think it's easier to figure out what's going on if we can visualize it with a graph. Let's make a bar graph with the income on the vertical axis and have a single bar representing Carrie's income on the horizontal axis. But instead of drawing the whole bar for the height of her income to scale, we're really only interested in a single box that represents her raise. So below the box, we could, if we needed to, fill in the rest of the bar for her income. But we're not worried about the rest of her income, only the raise. At the bottom of this box, the lower side of it represents her income before the raise, $31,450. The top of it represents her income after the raise, $33,250. And we have a line going right through the middle of the box horizontally that represents the cutoff between the 15 and 25% tax brackets. And that's at $32,400. The lower part of that box of her raise is still being taxed at 15%. But the top of it is being taxed at 25%. What we need to do is figure out how much money of her raise is being taxed at each of those rates. So if you subtract $33,250 minus $32,400, that tells us that the top portion of her raise that's being taxed at 25% is $850. We multiply this by the 25% to figure out how much tax she pays on that part of her raise, and it comes out to $212.50. We do the same thing for the lower part. Let's see, if we take $32,400 minus $31,450, we get that this is $950, and it's being multiplied by 0.15 because it's being taxed at 15%. And 15% of 950 is $142.50. So we add these two together because she does have to pay the tax on both parts, and we get a total of $355 that she's going to pay on this raise. So as you can see from the example, you should never turn down a raise. The total amount of tax you pay on the raise will never be more than the amount of the raise, because that higher tax rate is only paid on the top sliver of the raise, not on the entire income. The vast bulk of Carrie's old income is being taxed at the old rate. There's only just a little bit at the top being taxed at 25%.